We are back with another episode of OVTLYR University. OVTLYR University lesson number 3. This one is going to be the best one by far, and I am super duper stoked about this. Now, I do see that I'll most likely have to take a trade off, but we'll do that in about 45 minutes. I'm not really stressed, right? That's part of the game. But let's introduce those OVTLYR University students who have made it to class today. There is Joe, who decided to show up today. What's up, Joe?
Hey, Chris, how you doing?
Hey, man, I am great. I'm better now that you're here.
All
Let's
right.
get Deep Thought on the line. Deep Thought's here.
Yeah.
And we've got Paul Dennison from the Deep.
Hello, everyone.
Good to see you, Paul. Then we have Salty Brad on the line.
Hey, y'all.
We've got Mikey Mike in the house. Oh, Mike, I think you're muted. That's okay. And then we've got Dave all the way from Arizona. Dave, what's new?
Good afternoon. No, not much. Just excited to be here today.
Excellent. Okay. So, there's Salty Brad holding up Dave's trading journal. Look at that. Very, very cool. So we have a very, very, very jammed-packed lesson today. We actually will be going through a couple of videos, as much as I like to do a video, because these videos were some of the most important conversations I ever had in my entire life. And praise Jesus, I was able to actually get them on camera. So we can relive some of those moments, and that's going to be really, really awesome. So I'm glad you guys are here. Hello to everybody here in the chat. We will be taking questions in about the last 10 minutes or so. So be sure to hold your questions till the end, because they will get lost in the chat. We have over 300 people and growing who have joined us live. So I want to make sure that this is the very, very, very best trading education for you. And there's no paywall. Every bit of this is 100, 1,000, 1,000,000% free. So hope that's all right. So let's jump into today's presentation in OVTLYR University. And let me introduce myself. My name is Christopher Ewell. I've twice been awarded Top 100 People in Finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. We will be doing OVTLYR University every Tuesday and Thursday for a hot minute. We got 9 weeks of courses planned out, and it is going to teach you everything you could possibly know. But today we're on lesson 3, reading charts like a pro. This is the key to profitable trading. Now, as we go through this, I will be probably touching on some concepts you may not be familiar with. What I would request that you do is write down your question. That way you don't forget it, because I want to answer that question later on. And like I say, hold those questions till the end, and then I'll be able to get those to you. Now, the first thing you need to do when you are trading in the market is to listen to the market, right? There are unlimited opportunities every single day to trade. Every single day, there's an opportunity to trade. The hard part is figuring out which opportunities are worth your time. Now, I wanted to start off with this because this is a core tenet inside of one of my very favorite trading books called Trading in the Zone. There are unlimited opportunities to do unlimited trades every single day. But that doesn't mean you should, right? That doesn't mean you should be taking all these trades. In fact, it means you need to be even more careful. You need to start listening more to the market rather than telling the market what it should be doing, okay? So anytime that you say a stock should do something, you are not listening to what the market is telling you. Now, a lot of finance YouTube is exactly this. A lot of finance YouTube is where they're saying, oh, the stock should go up. Just this very morning, we were covering a video where the other person was talking about how Estee Lauder should go up from here. AMD should go up from here. Elf Beauty should go up from here, right? None of that matters. The market does not care. It does not give 2 monkey donkeys if you think the price of a stock should go up or if you think the price of the stock should go down. Your job is not to tell the market what it should do. Your job is to listen. The market is way bigger, and can do way more than you ever could on your own. You do not have deep enough pockets to move the market, unfortunately. But before we go too deep, we are going to be mentioning a couple things on fundamentals today, so I want to get those out of the way real quick. Fundamentals are the underlying data that the company announces, and it's usually on a quarterly basis, right? They might talk about their sales, they might talk about their profits. One thing you're going to hear later on today for a fact is called the PE ratio, the price to earnings ratio. I don't care what the price to earnings ratio is. I don't care about what any fundamentals are, not one. 99% of the time, the stock is moving with no fundamentals news. Right? Fundamentals come out 4 times a year. That means the other 364 days, including weekends and holidays, or 361 days, including weekends and holidays, the stock is going to move without fundamental news. So who gives a flying monkey donkey if something comes out on fundamentals? Now, granted, I don't trade through fundamentals because the price can move crazy, but 99% of the time, the fundamentals have no impact whatsoever, yet the price is moving. So waiting on those press releases can bankrupt you in between the announcement dates. So if you're holding on to a stock and it's going down and down and down and down and down, and you're sitting there saying, but I believe in the company. I believe that things are going to turn around. I believe that the price should go back up, right? The CEO is so great. All of these reasons, you can absolutely lose your shirt by holding on to a stock and not listening to what the market is saying. So here's the deal. Price. Price is the most important indicator of everything. Price is the most important indicator above all because profits follow price. You need to buy high, sell higher. Now, it sounds crazy. It sounds crazy. But the only way you make money in this game is to buy it when it's high and sell it as it's going higher. Now, I'm going to prove that to you today. And you're probably screaming at your screen, this guy's an idiot. He has no idea what he's talking about. His nose is so big and his glasses are so thick, but he still has no idea how you can't make money if you buy high and sell higher. It's not a thing. By the end of what we talk about today, you're going to be like, oh, okay. Maybe I should listen to Chris, who's actually made money in the markets, instead of trying to tell him what the market is doing, right? So let me repeat that one more time. In order to be profitable, but you have to buy high and sell higher. I know it sounds crazy. I get it. I completely understand. But this is how it's done. Now, what we're doing here is following the path of least resistance. So our goal as traders is obviously to make the most amount of money possible with the least amount of risk. But there's times the market feels like it's overbought. The market feels like it's oversold. The market looks irrational. Things are all over the place. But the worst thing that you can do is to get in the way of a price move. Now, I'll tell you a couple stories here. The second time I blew up my account, I was trading gold. And in fact, one of the videos we're going to cover today later on was not too long after that point. And I was having this conversation with one of my mentors. But it was because the price was going down on gold. There was somebody on Twitter that I was following at the time, literally had a monkey emoji as his profile picture, right? Faceless channel. And he was talking about how you have to buy gold. Gold is at a generational low, and gold is going down and down and down. And I'm looking at this monkey and I'm like, wow, this monkey must know what he's talking about. I should be doing exactly what he's doing. So I bought everything I possibly could. I bought GLD, GDX, GDXJ, Dust, NUGT. I bought everything that I could. And every single day, price was going down, and price was going down, and price was going down, and price was going down. And in the middle of this, I decided to take a vacation to Disney World. So my family and I are at Disney World, and I cannot focus at Disney World because all I'm doing is staring at my phone, watching as my account is evaporating day after day after day. And I had bought, long calls on all this stuff, right? I of course I didn't buy the stock. But I bought long calls on all this stuff. And when calls expire out of the money, which is exactly what was going to happen, these not only lose value, but they go to zero. Imagine buying an asset with the asset now like screaming towards zero. Not losing 5%, not losing 10%, screaming towards zero. And I'll never forget the time where I was standing at the window looking out over Disney Springs. They have this hot air balloon thing that's moving up and down. And I thought to myself, Chris, I cannot believe you did this to yourself. You blew up your account for the second time. Right? And it sucked. It sucked real hard, real bad. But it was my own fault for having done so. Because unlike what we're going to talk about today, I thought I knew better. I thought I was going to be able to ride the trend as it hit the bottom and on its way back up, and I was going to make so much money. But what ended up happening was I blew out my account, and it hurt. And what I did was I got right in the way of that price move. As price is coming down, I got in the way and I looked at it dead in the eyes and I said, nope, now stop what you're doing, turn around, head back the other direction. All right. We're no longer heading down towards the Gulf of America. No, turn the ship around. We're heading up to Canada and Chris is going to be buying a boat after we get done with this. Right. That was the plan. But that's not what happened. Right? So don't ever think that you're smarter than the market or you will get buried. You will get not burned. You will get buried trying to catch the tops and the bottoms. But you can make tons of money on the 80% in the middle. Remember, the top 10% and the bottom 10% are the hardest, the very hardest parts to trade. Trying to catch that top or catch that bottom. But the 80% in the middle, that's the path of least resistance right there. That's when you're listening to the market, letting the market tell you which direction it's going. Okay, next. Let's talk about the difference in assets versus consumables. Let's go ahead with that. Assets versus consumables. Now I'm going to call this the Texas Roadhouse indicator. So for those of you who aren't familiar with the Texas Roadhouse, it is a chain steakhouse. It's okay. It's not my favorite, but a lot of people understand what it is, so I like to use it. Now, a consumable is the steak. Imagine you walk into Texas Roadhouse, you get the rolls, you get that cinnamon biscuits, not the cinnamon biscuits, the cinnamon butter. You guys know what I'm talking about, right? The cinnamon butter. Let's add JC to the stage. JC, glad you made it. So we've got the cinnamon butter, we've got the rolls, and of course, Chris can't eat just one. So Chris is stuffing his face like a chipmunk, right? So I've got the big old puffy cheeks, going to town on all this, and then I open the menu, which sits on the table. They don't hand you the menu, right? So I open the menu and we see today that they're running a special New York strip, which is Texas Chris's favorite, which I heard a senator say that they're going to rename that to Texas strip. I'm all in favor of that. Just saying. New York strip is on sale. It's normally priced at $22, but today and today only, it's on a special for $14. Yeah, of course, it makes total sense. I'm going to buy the mess out of it. I might even eat 2 of them. Right? Because I could get one for like 50% off. Might as well get 2. So this makes total sense. This is a consumable. We understand that I'm going to consume the steak and maybe another one and the mashed potatoes and certainly the rolls with the cinnamon butter, right? This is a consumable. When you are buying a consumable, you want to pay less for it. Just a fact. However, that is not an asset. If I bought the steak today and I decided that I was going to hold it and try and resell it, right? Imagine JC, if I was like, hey, do you want to buy this steak? It's like a week old. I took a couple bites out of it. It was $14 when I bought it. Will you pay me more than $14? No, exactly. Exactly. Not going to happen, right? That's the difference in an asset and a consumable. An asset you want to own, and so it will appreciate in value. A consumable, like this jacket, like this shirt, like this DuckTales coffee mug, or like a steak, you're going to use with the intention of knowing it's not going to be worth more than when you bought it. You know that ahead of time. But so many people think that they need to treat stocks the same way. Stocks are an asset. Stocks are an asset, okay? Assets should be bought as they are increasing in value. And this is really hard for a lot of people. So going back to this slide here, if your home is going down in value, people don't want to live in your city, right? The market is telling you nobody wants to own it. Nobody wants to occupy the space that you occupy today. That sucks, right? They just closed down the Home Depot. The Target just got closed because of crime, right? Nobody wants to be in your city. And because of that, it's causing the price of your asset, your home, to go down in value. Or they just built a new Texas Roadhouse, right? They're adding a new Starbucks. Maybe if you're in Texas, you got a H-E-B and a Buc-ee's coming in, right? People want to be there. Commerce is happening. People are happy. They just built a new high school. All kinds of stuff is going on. They're building houses all over the place. That's where you want to be. That is the asset that's going to increase in value. So you have the choice. Do you buy because you have unlimited opportunities? Do you buy the house that's next to the crack house, has bullet holes in the walls? Nobody is there anymore. Crime is overtaking the city. For some reason, they decide to defund the police, which is so stupid. But point being is that nobody wants to be there. They're selling houses for 20 cents on the dollar now. Or do you want to be where they're building new high schools, they're building new Home Depots, they're building new Texas Roadhouses, you got a HEB that's going in, Buc-ee's, everything is looking great. Treat your stocks in the same regard. We want to be buying assets as they are increasing in value. We do not want to be buying assets as they are decreasing in value. And this is a big difference, a big mental shift between a consumable versus an asset. Do you guys have any questions here? Does this make sense, or do you have any questions?
Yeah, no, all good.
Very cool. I know you guys are outliers, so it's not the first time you hear me say this. But of course, remember, stocks are assets, and you want to be buying assets as they're increasing in value. Like I said earlier, that is how you make money. You buy high and you sell higher. Okay, just like if it were your house. Now let's talk about the market cycle, because we're going to be talking more about this in a little bit. This is what's called the market cycle. And this is not theory. This is real. And I'll show you real life examples of this. So stage one is where the stock is consolidating. Stage one is where it's figuring out if it's going to move. Stage two is this run right here. This is what everybody gets excited about. You want to be buying your house as prices are starting to move up. But before they started adding the Buc-ee's and the HEB and the Texas Roadhouse, right? That's when they start adding the belief and the thrill. Okay. So prices are moving up. Everybody's happy. Everybody's making money. And everybody realizes, hey, you know what? This is easy money. Everything is so good. We're going to take it so easy. Just buy, buy, buy. And then people get complacent. Right. So now we're talking about stocks again. People get complacent, like, oh, it's only going to go up from here. But then the stock price starts to come down a little bit, and we've entered stage 4. So stage 1 is the bottom. Stage 2 is the move up. Stage 3 is the topping pattern. Stage 4 is the decline. This is where a lot of people get hosed in the market because they see a stock and they treat the stock as if it's a consumable. So the price is going down, just like my New York strip. And they're like, well, okay, cool. So if the New York strip was 22 and I can buy it today at 14, I'll buy as many as I can at 14. And then they come back in next week and they're like, wait a minute, now it's at 10. Okay, I guess I'll buy some more at 10. And they come back next week and they're like, wait, hold on a second. It's at 3? Something's not right here. Why did I buy all this at 14 and then 10 and at 3? Well, the market's telling you nobody wants it. And you have a whole freezer full of New York strips now. Just like a lot of people have a whole portfolio full of garbage stocks because they buy it on the way down. And the problem here is that they're treating it like a consumable instead of like an asset. And now they hold on to it for months and months and months go by. And maybe if they're lucky, they'll get another chance at the stage 2. So here's what this looks like. Stage 1 is where it's going sideways. Stage 2 is the exciting part. This is where everybody wants to be buying stocks. The riches that people talk about is this move right here. Stage 3 is where you get really frustrated, right? Maybe you put on a couple trades and you've made a lot of money, but then you come to a point where, oh, you know what? The last handful of trades aren't working out so well. This could be stage 3. And then stage 4 is the downward move. Now, this is important. I want you to remember this because we'll be talking more about these stages in just a little bit. And then lastly, on this topic here, this is a cartoon that explains the market cycle. Now, on the outset, you're like, oh, this is a funny cartoon. But I want you to look at it. This is actually way deeper than you think. This is exactly what is happening to cause these moves right here. Because people, like a couple people say, wait a minute, goodbye, goodbye, bye, 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 bye. And that's why everybody's screaming right here. That's what's happening. Everybody's so excited and they want to own it. And so the stock is moving up, right? Because the more people buy it, that's pushing the price up, because more people buy it, which is pushing the price up, because more people are buying it, which is pushing the price up. Okay, this is a trend. And then when you reach the top, this person's over here like, I'm not really sure about this. I've got a stock that could excel, sell, 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 right? And then the stock price is going down because people are selling, which is causing the stock price to go down because people are selling, which is causing the stock price to go down because people are selling. This is the market cycle. And this is what is happening inside of this. Now, I told you that I would show you an example of a stock that actually has done this, and this is Tesla. This is Tesla stock. Crazy. But this isn't theory. This is real. And Tesla's a great example of, over a span of a few months, exactly the market cycle happened. You had your stage 1, your stage 2, your stage 3, and your stage 4. All of this happened. Your job as a trader is to listen and be able to read it. Your job is to listen and be able to read it. Don't tell the stock what it should be doing. Now, this is where the easy money is made, okay? You guys know, living in Texas, it's all about Texas barbecue, right? And I talked about it earlier, and we got to make sure that we are not fighting it. We need to figure out where the bottom 10% is, right? The bottom 10% of the move, where the top 10% of the move is. Both of those are incredibly difficult to work with. However, the 80% in the middle, going up or going down, that is where you make the easy money. This is where you make the easy money. And for context, that's what it looks like. You don't buy the sandwich for the bun. You buy the sandwich for the stuff in the middle, right? You want that saucy, delicious Texas brisket goodness right there, right? Now we talked about, what did we talk about? We talked about New York strips. We talked about Texas brisket. Tell you what, I haven't had any lunch yet. I definitely should have some lunch after this. But here's the deal. This is, in all reality, what you need to conceptualize for trend trading is, I want to catch all that meat in the middle. I'm not worried about the top bun. I'm not worried about the bottom bun. But if I can get that meat in the middle, I can make so much money. So do you guys have any questions on this? JC, yes, sir. I was hoping you had questions. JC, you're muted.
Yeah. Got it. I believe it 100%. I've lived it in my own retarded way by losing, of course. But have you ever done, for someone who needs to understand this, if this is not enough, say, take Tesla, people who bought it 5 years ago for $17 and now it's whatever. And that is their reason to go long, buy the dip. Oh, 5 years, you're not buying for now, you're buying for 5-10 years from now. And with the explanation that what has the stock market done over the last 20 years? Gone up. So yes, it'll do this, but going up. I know for a fact that if we could add up all the 80s over 5 years, it would supersede the $17 to $340 gain. Have you ever done a mathematical model, an example of a stock? Say, here, take this guy here over 5-7 years, whatever. You bought it for 17, now it's 340. You made X amount on your money. If you would have done the 80%, this would have been the result. Have you ever done that?
No, I've not, but I like where your head is at. So let's look at a slide real quick, or let's look at a stock. Let's look at Apple. Right. Well, I just pulled Apple out of a nutshell.
Because that would kill it.
Yeah, for sure.
That would kill it.
So,
I mean,
so imagine,
bam.
let's draw on this, right? Imagine that you did something like this, where you got in as it's going up and you did not get in as it's going down. You got back in as it's going up. You did not get in as it's going down, right? You skip this entire move. You get back in as it's going up. You miss this entire move going down. You get back in as it's going up. I mean, like, even a 7-year-old could say, okay, this plus this plus this plus this is significantly greater than this to this, right? We can see
correct
easily, and that is how trading is done. That is exactly
the
what
summation of the 80s.
Exactly. For sure.
The
Yeah, this
summation
is our
of the 80s,
objective
right?
right here.
Have you ever done that in numerical terms?
No, I haven't, but it sounds like a brilliant
Have
idea.
you ever done that in numerical terms?
No, I honestly, it's a tremendous idea, but I have not. But I mean, that's the objective here with trading, is just run it up, get out of the way, run it up, get out of the way, for sure. Okay, so we're going to change gears a little bit, and we're going to watch a couple of videos. Now, we're not going to watch the entire thing. I've already gone through the videos, and I've captured the spots where I want to start and stop it. But if you want to follow along in these videos, if you go to my channel and go to the OVTLYR University playlist, they'll be right there for you. So this is part of our curriculum. And in fact, this is going to be your homework, is I want you to watch these entire videos between now and Thursday. Just while you're going to the gym, while you're driving down the road, put it on the background and listen, right? You're going to see itty bitty baby Chris learning a lot, basically being slapped by two of his mentors. So I'm going to go to the best, most important, most slappiest parts. And we're going to watch these together real quick. So first is Mark Minervini. So this is a video that I did with Mark. Let me make sure we can see everything. I'm going to turn all of us off here. This is a video I did with Mark in 2019. And I have all the spots marked where I want to go to. So we're going to start at 4 minutes and 50 seconds. And here.
I first started, I wasn't cutting losses. As a matter of fact, that was not only was I not cutting losses, I was doing the complete opposite of what I do now or what I've done for the last 30 years or so. And that is buying stocks that are very strong, that are showing, momentum, earnings. Prior to that, when I first started, I was buying stocks at the 52-week low list that were low priced, and I would hold them even if they were down. I would double up on them, and of course that led to miserable returns, and I ended up having to switch all that and turn it all around. I had to turn that entire strategy on its head.
Okay, so first thing that he talked about here was he wasn't cutting his losses. Now, we haven't talked about cutting losses yet, but he's talking about how he was buying low price stocks, not buying the leaders, and he wasn't making any money. And he realized that he needed to turn that around. Now, who is Mark Minervini? Mark Minervini is a two-time U.S. Investing Championship winner, U.S. Investing Champion. And I will absolutely be in that club in a hot minute. I'm very excited about that. But not only that, he's one of the market wizards, and he is regarded as one of the very best traders of all time. So take every word that he says as if it is gospel, because he knows exactly what he's talking about. Dude has made ungodly amounts of money in the market. And he's the one who said, don't tell me what you were doing with your strategy. You need to shut up and listen. That was one of the biggest things he ever said to me. He said, don't tell me what you're doing. Shut up and listen. I was like, all right, dude, you're right. You're right. Okay, let's go to the next clip right here at 6:25.
All mapped out the night before as far as your whenever you, but one of the things you talk about here is
look at itty bitty baby Chris. That was from 6 years ago.
the fact that you, whenever you're looking to put on a trade, you have it all mapped out the night before as far as your entry and your exit points. So you've taken the emotionality out of it, where you already know where you're going to exit long before you even put the trade on. Where did you figure out that was the best method? Because honestly, I when I was reading that, the green light went on in my head, and I was like, of course, for me, I had put it on, or it made the trade as I'm putting things on, made the plan as I'm putting things on. But the night before, removing all emotionality out of it, how did that come about?
Well, it came about from having a lot of emotional traits, and realizing that when you're in the thick of it, you're not making the best decisions as far as decisions that need to be unemotional. So, if you go in with a plan that's already been established, now it's just a matter of executing your plan. And when that price gets to that point, you're prepared, and you already know. I mean, I don't just prepare just for the stop loss. I'm prepared for just about everything. I mean, if the stock were to do just about any type of price action or certain news would come out, I have contingency plans for pretty much any scenario. And if I don't have one, then there will be one after that new scenario occurs.
So I wanted to share this because this is so important. And I talk about this all the time, knowing where you're going to get in and where you're going to get out before you put on the trade. Before you put on the trade, you know exactly what you're going to do. And he talks about making that plan ahead of time. So while you're in the moment, you're not getting greedy. You're like, well, I'll just let it run. I'll let it run. Or getting scared, and you're like, well, I'll hold it. I'll hold it. Or doing the opposite, where you've made a couple bucks and you're like, well, I better take it now, so I won't have it. It's important to sit out when you're not emotionally invested in a stock and make that plan. And that is so, so critically important. All right, let's go to the next clip at 9:15.
Popular phrase is buy low, sell high on Wall Street. Also, if you were to go to a store and you saw a nice, Armani suit on sale for what used to be $1,500 and now it's $500, you'd probably think about buying it and getting that great deal. So
Right. Remember the consumable versus the asset. You're getting a great deal versus buying an asset going up in price.
you have that naturally have that mentality that if something's down, it's a bargain, especially if you see it's like Starbucks or it's Amazon, some company that you know very well, and you're like, well, how are they going to go out of business? I mean, everybody's going to always be on Amazon or always drink Coca-Cola. Well, they do go out of business. The companies go out of business. Business dynamics change, and sometimes they don't have to go out of business. The stock just stays down for 10 or 20 years, and you don't make any money. So it's as far as the PE is concerned, it's more a gauge of sentiment, and you're going to have low PEs in bear markets, high PEs in bull markets on the general market. And in individual stocks, you get what you pay for. If stock is growing very rapidly, you're going to have to pay more for it. It's that simple. You don't go into a Ferrari dealership and pay a Hyundai price.
There you go. That was what I wanted to get to. You don't go into a Ferrari dealership and pay the Hyundai price. That's how you need to be looking at your stocks. You need to be spending more on them. It sounds crazy. But you need to be spending more on them, because if you're spending more, that means all the other people who are interested are also spending more. And you cannot move the stock on your own. You need all the other people interested in it to help push the price up. So buying high is how you have to do it. You have to buy high and then sell higher. Now, I understand that it feels really uncomfortable, right? It feels super uncomfortable to be buying a stock as it's going up. But if we look at the SPY, right? When would you have said this was the highest point, right? You look at the stock right here. Oh, that has to be the high. And then it continues up higher. Oh, that has to be the high. And then it continues up higher. That has to be the high. It continues up higher, right? We can't tell the market where it's going to peak. Just like we don't want to eat the top bun, but we have to, because that's what contains the sandwich. We have to let the market tell us which direction it's going. Let's look at one like HIMS, this huge run up right here, right? If you bought it right here, you might have thought it was the high. If you bought it right here, you might have thought it was the high. And if you were still holding it right here, you're probably thinking, oh man, this has to be the high. And then it continues up even more. And you're like, oh, this has to be the high right here. And then it goes up even higher, right? Now, of course, there's a point of diminishing returns, like on this one right here, right? You're so far away from all the moving averages, which we'll talk about in a little bit. You're so far extended that you never know. It might just snap back. So we'll talk a little bit later about keeping your risk to return in check, right? Because entering right here, where your risk to this trailing stop, the risk to this exit point, if you were to use it, is really small. Whereas if you enter up here, the risk to this point right here is substantially more. So you do want to be buying it as it's going up, but there is a point where it can take off. And if you didn't get on, you don't want to be chasing it. So let's continue on to the next spot here at 10:56.
It's so contradictory to basically everything that I've been taught and a lot of the market participants out there. And I think that obviously is part of your mentality is, that's not the end of the run. In fact, that's probably just the beginning. So that was such an interesting point when I was reading through here, and really, honestly, to me, kind of changed the perspective on what a value investment would be, right? Once you start seeing the stage 2 run up, is you spend a lot of time working up in here. And I really would suggest that all the audience out there get this.
Okay, so I'm not sure if I captured the exact right clip, but point is that while it's running up on that stage 2 run up, like we talked about earlier, stage 2 right here, it feels like the top on every single day. Every single week that goes by, it feels like it's the top. But you've got to let it run. You have to let it play its course. And it gets really, really, really uncomfortable on its way up. All right, let's go to the next spot, 1310.
So I want to make you even more understand this, and I think another light bulb will go off. So let's say you had a stock that was at $100, right? And you had a bear market, and it went down, let's say 50%, because that's a pretty big correction, right? So the stock goes down 50%. All right, you buy it at the absolute dead low. You're a clairvoyant. You have a crystal ball. You buy it at the absolute dead low. Now that stock goes all the way back up to where it had once traded at its highest point. How much would that gain? Just to get back there, 100%, right?
Right.
You're up. You'd be up 100% if you bought a stock that was down 50% and it went back into new high ground. Okay, so now let's look at a stock like Cisco. Cisco went up 70,000%.
Holy cow.
Home Depot went up 40,000%. You've got stocks like Amazon up tens of thousands of percent. I can go on and on and on, the big leaders. So if you were to buy at the absolute low and then sell at the high and be afraid to buy stocks at the high, you would have given up 69,900%. You would have gotten 100%, but there was 69,000 more percent. So my point is that the big money is made in new high ground, because for a stock to make a big move, it has to make a new high the entire way. There's no other way to do it. It can only make, if the stock went down 99% or 90%, it would have to go up 900% to get back to a new high. But even that, if you take 900% off of 40,000% of Home Depot, you still left 39,000% on the table. So the big money is made in new high ground when you get a stock that makes a multi-year move.
Okay, so that's what Mark was just saying right there, is that it gets really uncomfortable as you let the stock run. But the only way you make big profits is by letting the stock run. Do you guys have any questions? I can stop right here for a moment. Do y'all have any questions? JC.
Yes, sir. Question on options. When you say don't be afraid to buy high, it's going to be expensive. That's especially true on the options. That's why the good options cost a lot of money. So you can't go cheap on the options unless you have a plan and analyze everything. If you analyze everything and everything is green, then pay the friggin' option, because it's expensive because it's a great option. Is that true?
That's a great point. I didn't want to get into options for another couple of weeks, but I just wanted to focus in on the price of the stock. But you're totally right, right? The more expensive the asset is, the better it is, right? Right. Imagine that this is your neighborhood, JC, right? We're down in South Beach and we're like, hey, we need to buy a new condo, right, with an ocean view. And it's in the good part of town. And you see that the prices are going up and you're like, oh, this is awesome. Let me go ahead and get in, right? It's going to cost you a lot more here than it did over here before people got excited about it. And then as people are getting more excited and they found out, oh, you know what? South Beach is the place to be. It's real happening. Everybody wants to be there. They just put a Buc-ee's in there, if you can believe it. I don't know where, but they did. Texas Roadhouse is going in. Everything is looking great. And it's getting more and more and more valuable. That's the time when you want to be buying a stock, just like the time you would be buying real estate.
Got it. And another thing is, I know we want the 80%, but you don't want to cut your losses too soon. And we're not going to talk about the options and rolling now, but just to look at the asset. Would you prefer to get out before it hits the peak, or catch it once it hits peak and you see it come down? It might be a false down, but would you feel more comfortable getting out a little bit after the peak than before the peak?
I think that's a beautiful question. And the thing is that JC, in fact, let's do this. Let's do this thing called a replay. It's really cool. Right. On any one period of time, we don't know where it's going to go next.
Right.
Right. So to say get out before the peak, we would have got out maybe down here thinking that this was the top. And then it runs up from $41 up to $70. So it nearly doubles in this time frame right here. And it's like, oh man, look at that. It went up even higher, but we don't know that. So that's where I would say wait until the market tells you when it stops going up, right? And we do that with a trailing stop. We'll cover that
Got
more
it.
in just a little bit, but a trailing stop allows it to go along with you all the way up. And then at some point, if the trend reverses, you'll know. It'll be as plain as day. You're going to know. Yes, sir, Paul.
So, Chris, and with the volatility in this market, is that one of the reasons we're getting out, like at 2 ATR, or where the fear and greed hit 63 in a more stable market, and just a stock that's slowly climbing up? Will we not hit those big fear and greed numbers that are going to make us exit, and we can just follow the 10 EMA and let it run for months?
Oh, absolutely, you could, right? And so that's a great question. For me, I like to use the fear and greed numbers inside of Outlier, but you can use a trailing stop. In fact, Steve Burns, we're going to cover him in a little bit. He talks specifically about letting a trade run for weeks or months at a time, until it hits the opposite end of that trailing exit point, right? So since we've had it brought up a couple times, let's talk about what a trailing stop is. A trailing stop is a number on your chart, and it can be the 10 period EMA, the 20 period, the 50 period, you name it yourself, that follows behind the price of your stock. And maybe you even say, okay, $1 from the low of the previous candle. Whatever the case is, you decide where that exit point is, and then you move it up along with the stock. Now, there are times like right here where you might get chopped in and you might get chopped out, right? We can see this blue line right here. It went under, it went over, it went under, it went over, and we don't know how far it's going to go at any one time. And so that's why if we do get the signal to enter, we got to let it run. We got to let it run as far as it possibly can go, and then only get the exit point when it turns the opposite direction. So speaking of turning the opposite direction, let's change directions real quick. I think I might need to exit SMCI. Let me turn this off real quick. Okay, so my exit point on SMCI was 42.97. That was the low of this candle right here. Actually, a little bit less than that low. I just moved it. Didn't mean to do that. And it's absolutely below that right now. It's at 42.95. We could give it a couple more minutes to find out, but it looks like this is a trade that I need to close. 42.97. I'm going to make sure it's sitting on that real quick. All right. Now this is this is one of my least favorite times, is when it's flirting with that exit point. It's like, come on, just be obvious. Be obvious one direction or the other. Yeah, now it's going to be back over here in just a moment here. So we'll give that another 5 minutes or so to work, and then we'll make our decision. But there will be no second guessing the decision. The decision has to be made. So let's continue on here with the next part. Was that 1604?
Is to be in the better names. They're going to make their big move, and again, if you go and you just take a chart and you plot the big move in a stock, if you put a little dot on all the new highs, you'd see that all the big move sections have all new highs.
Mhm.
And then you'll have periods, of course, where the stock will correct and go sideways, but it's impossible to make a big move without making new highs.
Okay, to that point, let's go back to HIMS. It's impossible to make a new move or a big move without making new highs, right? We've talked about that several times now. It's impossible to make the big move without making new highs. Let's go to 22 minutes. This is actually pretty cool hearing Mark's backstory right here.
You could get in there and take advantage of their big volume coming in and moving the price, and that's the whole idea. And that's where, when, just to give you a quick history, when I first went on Wall Street and I first made my name with the U.S. Investing Championship, and I made all those returns that everybody heard about, and of course Stock Market Wizard. I was a pro to the pros. I advised people like George Soros's Soros Management, some of the biggest hedge funds in the world, mutual funds, and you couldn't even get my research unless you were an institution. No individuals could get my research. That was my career on Wall Street. And then I retired. When I came and wrote this book, McGraw-Hill came to me and asked me to write a book. I decided to enlighten the individual so they know the things that I would tell the institutions, and also to know how to get in there and to move quickly and take advantage of their first mover advantage, or if you will, their speed and agility, to be able to take advantage of those institutions. And that's, you know, how this whole thing transpired with
So yeah, I just wanted to share Mark's backstory. Actually goes for another few seconds here.
the book.
Wow, that's incredible. That makes this book here, I think it was around $20, potentially the biggest bargain in human history.
That's this book right here, The Biggest Bargain in Human History. That's that exact book. Can you believe that?
Well, there's a lot of books that are incredible, unbelievable bargains. Most books that are written by successful people that tell either their life story or their methods are worth far more than the price that you pay for that, whether it's $30, $100. You know, books are relatively cheap for what you're getting. I have right now sitting in my office, I have about 4,000 books behind me in my library. I am a bookaholic. So, and that's one of the reasons why I write books, is because books have been so pivotal in my life.
Oh, absolutely. And I also, I'll teleport to my library real quick. I am the exact same way. I got books out the wazoo, all books all over the place. I am also a bookaholic. So that's why, one of the reasons why Mark and I got along as we did. Okay, I think I need to close my trade here. SMCI is now heading south. It's at 40. Hold tight real quick. I need to change a couple things around. It is at 42.83. So it's a good 10 cents below my stop out point. 15 cents below, 20 cents below. That's fine. So the point is now we need to get out. So let's go to SMCI. And I am currently in the June 6th 38s. I'm going to go June 6th and then the 38s here. And we need to close full position. 585. Let's see if we can get filled at 585. All right, working at 585. I may have to go a little bit lower. Just a second here, gentlemen. Okay, it's filling. Okay, average fill price was 575. So I'm out of SMCI. Small loser. I'll give you all the details later on in the Discord, but that's what you have to do, right? You have to execute. I see that I need to get out. I see that I need to execute, right? Now, is this a big deal? No, just a scratch, especially having come off of giant wins last week. This is negligible to my portfolio. So let's continue on with Mark on here. I think we just got a little bit more left for Mark, and then we'll switch over to Steve Burns. Well, actually, this is the last one. So this is at 25.22. Okay, this is actually the most important part. So I say the most important part the last. So you may have come across people talking about contrarian trading. If you have heard people talk about contrarian trading, raise your hand. Yeah, it looks like at least half of us have. Now, what does that mean? To me, that meant if a stock's going up, I need to sell it. If a stock's going down, I need to buy it. And I lost so much money doing so. It was like I couldn't possibly make money. Ozzy Ian, same thing. The price was going down day after day after day. I was buying it day after day after day and suffering. And it sucked. And so I specifically asked Mark about this because Mark talks about how he's a big contrarian trader. And yet he talks about going with the trend. And it's like, how can you do both? How can you be a contrarian trader yet go with the trend? How can you be greedy when others are fearful and go with the trend? This doesn't make sense to me. So I'll let Mark explain it.
Oh man, that is so incredible that we have such a vast amount of knowledge packed into here, and that, you know, it's not just one person's conjecture on what's actually going on. It's actually what you've experienced and what you've advised on Wall Street for the institutions. That's incredible. So for a novice trader, right? This was going through my mind. What do you feel is just an easy way that somebody who's dipping their toe into the...
Hang on, I'm sorry, that didn't go where I wanted it to. Here.
you get at it. Very aggressive steps.
It's not just lazy, all the what is interesting to you, what's out market wizardry, all the
Hold tight.
cover on that makes sense. So the last thing that I wanted to cover on today's topic here, and honestly, this has been bothering me for quite a while. The people that I learned to trade from call themselves contrarian traders. I also consider myself a contrarian trader for a long time. And like you were talking about earlier, picking the very bottom, picking the very top, and then riding it back. But I found that that's next to impossible. And I lost so much money with this contrarian trading style of trading. I mean, do you feel that there's any place for that in the market? Because here, I mean, you really focus on the cycle of the stock, right? There's stage 1, 2, 3, and 4. Stage 2 being your main focus on, you want to get that huge exponential growth. And if you are a contrarian trader, that's the absolute worst time that you're looking to get in. Do you really feel that there's any place out there for contrarian trading?
I'm going to tell you right now, this was one of the moments that changed my entire life. This next 30 seconds or so changed everything for me. So don't take this lightly. I don't want you to listen to this passively, but actually learn from everything that Mark's saying. Because I was listening, it changed everything for me.
Okay, so let me just tell you this. If you're buying stocks at lows and trying to pick bottoms and doubling up when stocks are down and ignoring your losses and not cutting your losses and buying low PE stocks or penny stocks and going against the herd, as far as, everybody's bearish on a stock, so you think it has to go up. If that's what you're doing, you're not a contrarian. You're doing what most individual traders do. And that's why your returns suck, and that's why most traders' returns suck, because you're not a contrarian. If you want to be a contrarian, buy stocks only going into new high ground. Only about 1% of investors do that. That's actually being a contrarian. So if you think that everybody's doing what I do, well, then how come everybody doesn't have the returns and the success that I have? If they were, they would be. So I'm really the contrarian. And I know what you're saying in the sense of meaning that, a contrarian meaning that the stock is down, so you go long, or it's up, you sell. I understand that. But in the true sense, you are a contrarian when you're doing what most people are not doing. And by being a contrarian in the traditional sense and buying stocks when they're down and doubling up on them because it's a quality name, and you trust that the management is great, that's actually, you're doing what most of the mediocre performers are doing.
Oh, I can tell you from my returns that that's exactly the case. I'm the first one to admit that I am far from a stock market wizard. And in fact, that's why I like to have people like you on, smart people who have been out there and experienced it, to really, for my own selfish reasons, to learn from you guys, but B, to share it out there with so many other people. Because exactly like you were talking about, if the stock was up, I would sell. If it was down, I would buy. And that was my quote contrarian trading. And my returns were super not great. That's the easiest way to say
at some point you have to sell when the stock's up. You don't just not sell because it's up. But bottom line is, I spent 6 years, or a good part of that time, trading that way and buying stocks that were down, not cutting my loss, and I had nothing but miserable results for almost 7 years. And then when I flipped everything on its head, it took me a few years to figure it out and to understand how to implement that completely opposite strategy. But then it only took me about 6 or 7 years to take a few $1,000s and turn it into millions, and the rest was history after that. So I became very wealthy from doing the exact opposite of buying stocks with low PEs. And so when people ask me, that's my wheelhouse. That's what I do. Is there maybe a way to make money another way? Sure, I'm sure there is. I'm sure there's many ways. This happens to be the one that I know, and I'm an expert at it.
Yeah.
Okay. So to his point, right, we want to be buying high and selling higher, right? the objective here is to be buying the best stocks out there, and the best stocks out there are not the cheapest. Not the cheapest. Okay, before we move on from Steve, or I'm sorry, from Mark to Steve, do you guys have any questions? No? Okay, cool. I love this. This is so great. Oh, Mikey Mike.
Not so much a question, but when you were talking earlier about watching, it's hard for people to watch a stock get run up. And I actually kind of like on SMCI, just watch. I was actually like in that mindset of, I'm just going to, okay, there's my half ATR, but I'm still going to just keep watching it a little bit longer and a little bit longer. And I can see people hanging on to that more than going the other way. Like, I like to see it go up, but I caught myself doing it. I was like, just get out, just get out now. But I just kept thinking, it's gotta, surely at the end of the day, it's going to just explode into all this money. But anyways, I just had that. I kind of worked the other way on it. I don't know if that's the norm, but you're just kind of hoping that changes. And I did go ahead and stick to the plan, but you're just kind of, man, I hope this plan's right.
Yeah, well, here's the deal. We don't know if the plan's right or not, but we do know that that is an exit signal. Okay. And it's always the right thing to do to take your exit signal. Good trades, bad trades, winning trades, and losing trades. Right? A bad trade is one where you don't follow your plan. A good trade, no matter the outcome, is one where you follow your plan. So you followed your plan, and that is exactly what you should do. Right. And could it be more profitable? Sure. Does it suck to take a loss? Absolutely. I'll be the first one to do that. But it sucks to have a loss today versus take the loss, a few days from now when it's significantly more, right? Because, dude, I remember so many times being like, okay, I'll give it another day. I'll give it another dollar. I'll give it, I'll wait till tomorrow morning, right? All these other excuses that I could come up with. I've been through it all. And nothing works except following your plan. Deep Thought, you had a question.
Yeah, just also to add to that was one of the contrarian things to do is not revenge trade after you've been stopped out of a trade, because that, I think, seems to be a big factor psychologically. Sort of try and chase that stock again. They talk about that in turtle traders, where the guy keeps trying to chase a stock after you've been stopped out to sort of like wants his money back from that specific stock itself, almost like a bit of revenge. So
or it's like, oh man, I lost money. Now I have to go make it back up as fast as possible. Yeah. Right. And it may not be the right trade for you, but you feel like I have to do something to make my money back. I got to go fight the market to get my money back. But what ends up happening is you now have lost 2 trades. So you take an additional risk to lose even more money. Yeah.
I feel that right now. Like after I close that, like, man, I got to jump in there now. But yeah, I get that. So
dude, that's great. What you're feeling, Mikey Mike, that's normal. What you have to do is overcome those feelings, because normal won't cut it. As Mark said, that's why most people suck. They can't do what we do. Is because that emotion you're having right now, there's nothing wrong with that. I don't want you to feel like you've done anything wrong. That is common. We now have to break that, right? We have to do the uncommon things in order to get uncommon results.
Yeah.
Joe had a question.
Oh, I don't have a question, but maybe just a thought for later classes is I'm interested to see why the stock's fear and greed score does not keep us from following a stock to the point where we get that rubber band effect. So as we climb up, it feels like the fear and greed score would also be climbing up at an accelerated rate. So interested to see why that doesn't happen.
Well, it doesn't move linearly. I mean, you could pick any stock on there, and you can see sometimes where it moves very small increments. And that was one of the things I asked for from Mahesh, was I wanted to see the numbers. In fact, way back when, it was just color codes, and I was so pedantic, so exacting in my strategies that I would actually there's this color picker Google Chrome extension, and I would go in and I would see, okay, what color was the best color for exiting on the fear and greed heat map. And then that's when we got the actual number scores that go from 0 to 100. So yeah, and you'll see when a stock's really taken off, it'll go from like 50, 51, 52, 57, 73, 84. It does not go in a linear fashion when it's really taken off. But really good observation. JC.
Yeah, I mean, I see that in my gym and in our field as well. My son finished high school, no college, never took a certification course. He's one of the best trainers we've got. Why? Because he never learned anything except the right way to train. My question to you is, and maybe you don't have the answer, but okay, so right now, dude, I don't care if it's Tesla. I'm not emotionally attached to anything. You tell me go out when it says 5. When it hits 5, I hit the button. There's no emotions because I don't have anything to be emotional about. My question is, when I start learning this, am I going to be eventually become emotional? For any of you maybe that were where I'm at now, does the emotion come back and bite you in the ass? Is that something that everybody eventually catches, or is it possible to kind of, you didn't go in with any emotions and that's just the way you roll the rest of your life?
If you can go without any emotions, even with trades on, that's a very rare thing, JC. Super rare, right? Because I mean, it's just the normal fear and greed that goes along with any person out there. But if you can roll with that, then dude, you got a leg up on everybody. But as far as like unlearning,
I will report.
Yeah, I mean, if you don't learn
I will
the
report
bad
as
habits to start with,
I will report to you guys as I go along.
that sounds good.
Yeah,
But
I'll
like
let
for
you
me,
know how
I
it's
had to
going.
unlearn, right? I went for years, like Mark was talking about, doing the wrong things. So then I took years to unlearn the wrong things and learn the right things. That sucks, right? That's why Outlier University is so important to me. Because if we can skip the bad habits and go straight to the good habits for you, you will have exponentially more money in your account faster. And that is my goal. That is my goal, is to have you skip all my mistakes and go straight to the things that are working.
Thank you.
Very cool. All right, let's now shift to a different video. Hope you guys don't mind these videos here. Actually, let me ask you this: do you guys like the videos? Do you like to hear directly from them, or do you want me to do lectures? Because
Yeah, no,
I
it's
feel like
good.
this is useful,
It's
but I want
good.
to hear from you.
It's good.
Okay, we like it.
What's
Cool.
been interesting for me is I've listened to your videos for ages now, and to actually hear it from the people who mentored you, it just has a different impact, you know. So it's
Yeah.
been pretty cool seeing this video.
Yeah, for sure, for sure. Now this is Itty Bitty Baby Boy Chris from March 5th of 2019. I will give a very big disclaimer to this because I know people are going to put it in the chat. I had a cold. Itty Bitty Baby Boy Chris had a cold, and you can hear because my microphone was right next to my face, all my little sniffles and things like that. So get off my back. I know it's there. I know it's coming, and now you know, so you can't make fun of me for it. Okay. So this is a video, Steve Burns' newest book, 50 Moving Average Trading Signals That Beat Buy and Hold. So this is the first clip right here that I want to go through. Yeah. Don't try to predict the markets. React to what's telling you.
Extremely guilty of trying to predict the way markets will go. Before reading this book, on my charting platform, I had some moving averages. I had RSI, I had MACD, I had slow stochastic, I had PSAR. I had a whole bunch of crap. Let's put it that way. And I'm trying to look at all of them. And I'm like, okay, this means it's going to go bearish, or this means it's going to go bullish, and not actually looking at it from a reactive standpoint of price is telling you this, you do that, but more of like, I think it's coming. I think it's about to turn. I got to get ready. I got to get in front of this train. This train's about to turn around.
It reminds me of high school in the 80s where we used to write. I mean, the kids nowadays wouldn't even realize this. Back, we used to actually write code in high school for like the old computers. We'd have like line 10. You know, that's a question, yes or no. And we'd have line 15 or 20. If yes, go to this. If no, go to this. Sort of like a binary decision tree. And I think that's where people can really change their trading if they can get to that, where they have I think it's called Boolean logic, where you make decisions based on current things going on, and you take a path based on reacting to circumstances. Totally different than, goodness, probably 89% of traders actually do, even some professionals.
That's really clever. I like the idea of it being somewhat of a computer programmatic reactionary, if this then that type of trading setup. That's definitely much more my style, especially as we've talked about before. I don't want to be stuck in front of a screen all day long. But if I can have an idea, you know, if price is showing it's going to go in this direction, maybe not for long, and that's another thing we're going to talk about here in a minute. Maybe not for long, but it may be for a while, and price is moving this way. Why not jump on board while it's going?
Yeah, the path of least resistance is the easiest way to make money in the markets.
The path of least resistance is the easiest way to make money in the markets, right? Capturing the 80% in the middle right there.
Without
If people
Oh, I
are
was just
bidding
gonna
up
say
a
without a
price, if people are bidding up a price, you know, you want to be on the side of the trend on the upside. If there are no bids going higher, if it's going lower, you want to be on the either be in cash or be on the right side of the flow of the capital. Like Paul Tudor Jones said, the whole world is nothing but a flow chart of capital. So you just want to be where the money's flowing, and money always flows for returns.
There we go. Okay. So what Steve is trying to say here is, of course, staying with the side of the trend. Let the trend tell you which direction it's going and then follow along with that. Let's skip ahead to 818.
Yeah, that's a big thing people miss, because the risk reward ratio. You know, if you're wrong, the most you ever want to lose is 1% of your capital. But if you're right, you want to make 2% on your capital, 3%, 4%. I mean, whatever you can make. You just want to have that great asymmetry going with small losses and big rewards. That's really the key to profitable trading. Everything else is just details on how you do that.
Okay. The key to profitable trading is small losses and big wins. Let's go back to HIMS real quick. We talked about, it was over here. Getting in as it's close to your stop out point. You want it to be close to your stop out point. I know it sounds crazy, but you want your entry to be as close to your exit as possible. Because if the entry is close to your exit, it doesn't have much room to go against you, right? So if we measure this out, we're just using this one candle in particular, it's 5.82%, which is quite a bit. 5.82%. But if we were to enter on this giant candle from the close to our stop out point, that's 24.69%. So we actually want to get in as close to our exit as possible. I know it sounds weird, but it means that if we have to turn around and run to the door, right? Imagine you just walked into a crowded theater and somebody yells fire, right? Can't do that in America. It's against the law. Right, that's the one thing that's against freedom of speech. You can't yell fire in a crowded theater. But if you do, you want to be close to the exit, right? I mean, you want that back row so you can turn around and head right back out. But imagine you're all the way up at the front row and someone yells fire. Now you got to fight through everybody else who's trying to exit too, right? Women and children first. You got babies on both your shoulders. You're elbowing people out of the way. Like, get out of I have to get out of here now. Do you not understand that there is a fire? Versus turn around, back out. That is the difference, right? That's why I say you want to be as close to your exit when you enter as possible. Because the market's going to tell you if it's going to work or not, right? You don't have to wait there for a long time to find out if it's going to work or not. Okay, next clip, 14 minutes. Here.
Mathematically like that?
Yeah, I went to even number.
The 25 may work. Did you just go through mathematically like that?
Okay, so I was asking Steve about the different moving averages that he was testing, and I was asking him a little bit of context here. If he went through like 1 EMA, 2 EMA, 3 EMA, so he gives some context as to how he figured out which moving averages are better than just holding buy and hold.
Yeah, I went to even numbers. I did like a 1020. If that didn't work, I'd go at 1030, or I'd go at 530, or I'd go at 1040, and I would see what worked. And generally, though, if you have none of those work, then you don't have to drill down into like 8s and 5s and 7s and 6s. You know, if the round numbers don't work, it pretty much shows that nothing's going to work around that time frame, because it's not filtering enough volatility, or it's not having enough trends historically.
Okay. So to that point, what he's trying to say is you can overfit the data. Overfit meaning if it only works on the 7 EMA, but it doesn't work on the 6 or the 8, that's not a strategy that is universally applicable, right? If it works on the 10, then it should be able to work on the 10 on this stock and the 10 on that stock and a 10 on another stock. And that's what we're trying to do here is we want to find the most broad strokes as possible versus all the little fine details. If we can find in broad strokes that these moving averages apply to everything and give us context that helps us stay in a trend for as long as it can and get us out of the way when it turns around, that's our objective here. But if we can only trade it and it works on a very small time frame, then it doesn't work at all, right? It's I think the military has a phrase. You want to be anti-fragile, right? If you have a trade that only works on the 7 EMA, that is a fragile ass trade, right? That trade cannot survive given any sort of battle circumstances. But if you have a trade that works universally well on the 10 EMA, it can probably work on the 9, it can probably work on the 11, it might work on the 8, and it might work on the 12. But in general, in large swaths, this is anti-fragile because it can apply to all kinds of positions. It can apply to all kinds of time frames, and it can apply to all kinds of stocks. That is the objective when you find a strategy, is a strategy that works in all kinds of situations. Let's go to the next one here. That was the 14-minute. Let's do it at 26:05.
Win rate with a 5-to-1 risk reward ratio.
Yeah, and that makes so much sense. And this is the kind of stuff I wish I'd known sooner. You know, instead of the buying something and hold and hope, or whatever they call it, right?
Mhm. Yeah.
Whereas there's no mathematical quantitative approach to say, hey, you know, things are going your way when you're staring at the face of several losers there. So yeah, really, really interesting and very useful to me as I'm reading through this, and certainly would be useful to all the audience members there.
Yes, the principles are really powerful. It's the principles to create something you are psychologically comfortable with doing, whatever that may be, in whatever market and whatever time frame. Really, it's the principles that are powerful. Most people didn't have the patience.
The principles that are powerful works on any market and any time frame. That's what he's trying to get across here, is how powerful the principles are.
To sit and have a 10-day, 50-day crossover and hold it for a few weeks like I do. That can be frustrating for some people. And other people might, have an end of month signal. People love the SPY into 200-day end of month. If it's above it, you stay long. If it's below it, you go back to cash. Some people that, used to be buying holders think that's a really active trading system. So you have to have something that fits your own belief system and you believe in, you have faith in, that you can do whatever you can act.
Right. Having something that fits your own system, something you can have confidence in. Right. Because I could tell you whatever moving average I want, but if you don't have confidence in moving average, it doesn't mean anything. It doesn't mean anything if you won't actually execute the trade in that regard. All right, let's go to the next one here. 30-30.
A lot of people are really excited to trade and want to be like super active traders, right? They won't be making 6 trades a day, Steve. What do you tell those people?
I've been there and I've done that. I've done everything you can make up and think to do in the markets, and I just wanted to do what made money. I could care less. If I need to go sit in my screen all day for 8 hours and make money, I'll do that. If I need to sit on some great stocks for a year, I'll do that. I don't care. And when I didn't care, that really when breakthroughs came. Too many people just think they have to be doing something and working to actively doing something to make money. And my best gains happened when I was holding the right position and letting it run for weeks and months at a time. And sometimes for multiple months, and I wasn't in front of my screens all day. I was just, oh, good, Apple's up today, that's great, and go about my life.
Mm-hmm. Okay, point here is he didn't want to be active. You don't want to have to be active. You want to have a plan, execute the plan, and like Paul was asking earlier, right? Just letting it run, or maybe it was Joe, letting it run until it hits that exit point, and it may be weeks or months later. You don't have to do anything in the meantime, and you don't have to do any trades if nothing is set up for you.
And that's just, plus you gotta look at the cost of your life. I mean, how much would it cost to pay you? Your profit margins hurt if you're spending 50 hours a week trading. You have to account for the cost of your life. Spending 200 hours a week actively trading. Are you making enough money to justify that activity? That's something people also overlook.
Yeah, that's a really, really great point. How much time are you devoting to this?
I have a much greater profit margin, because I'm an end of day trader, and I have been for a long time. And I have a much better return on my time and energy by not having to sit there for 9 hours a day.
That sounds kind of familiar, right? End of day trading. So you don't have to sit there all day long. You look for your signals near the end of the day, last hour, last 45 minutes, last 30 minutes, find what you're looking for. If you see what you're looking for, execute at that time, whether it's opening, whether it's closing. But you don't have to sit there all day long looking at your phone. You don't have to sit there all day long stuck in front of a monitor, because you've developed that plan, like Mark talked about earlier, ahead of time. And only when one of those things happens in your plan, you developed ahead of time, occurs at the end of the day, then you can execute. And it makes life so much easier, right? You no longer have to stress at what's going on at 11:37. You no longer have to build your lunch hour to sitting in front of a screen. You have a window of time to make your executions, and then you execute. Let's go to, this is the second to last spot here at 34 minutes.
What I took that to mean is the day that it does cross may not be the right day to enter. Is that the way that you had intended it?
No, I think that's a misunderstanding. I don't know if that's even, it was supposed to be, you don't want to chase it. You want to enter it when the signal is given. You don't want to chase it later, is what that was supposed to have implied.
Okay. So you want to enter the day your signal occurs. You don't want to wait till the next day. If your signal is to get out, like today, right? Today's signal, Mikey Mike, was to exit SMCI. We don't want to wait until tomorrow morning to find out, right? Because it could gap down or it could gap up, honestly. We don't know. But what we do know is the data that's presented to us today is the data we need to make the action on, whether it's to get in or whether it's to get out. And it's not to chase it later on, right? If a signal comes through, an outlier is a great example. I will only take a today or a yesterday signal. If it's greater than today, which is T, yesterday is T minus 1. If it's T minus 2 or greater, I'm not interested. Because at that point, how far are we along the life cycle of this trade? How close are we to the exit points? Mike, you might had a question.
Okay, to that point, if you have a day-old signal and it's already moved five points, then you don't mess with it. I know on your screener you set it for 0 to 5% move. I'm just asking.
So
is that
I no longer have that on the screener. I only had that for a temporary time.
Okay.
I didn't like it when I added that rule, and this last week really cemented the fact that we don't need that rule. Like I think Robinhood was up like 17% before getting in, and we made buttloads of money after that, right? So, and to Mark's point earlier, is we want to be chasing stocks up because the stocks that are moving up, we're going to have to pay more for them. But there is a point where you need to decide if it's too far, right? And that HIMS example that we talked about earlier, right? If you've chased it all the way up here, even though your entry signal is back here, and you're like, oh, I'm not sure, and a couple days go by, oh, I'm really not sure, and then a couple nights go by, and you had a couple margaritas, and you're like, you know what, I'm going to do it. On Monday morning, I'm going to do it, right? And you buy it on Monday morning, and it goes right up and right back down. You're probably like, son of a bee, how could I have let this happen, right?
So stupid margaritas.
It was the margaritas, right? Man, I had a margarita this weekend. That was a dill pickle margarita. I was like, this is going to be, I love pickles. And I'm not so big on margaritas, but they took the pickle juice and mixed it with the margarita. And I was like, this is the greatest drink of my entire life. I cannot believe that this exists. So totally off topic. But yeah, there you go.
I'm trying that.
Okay, so this is the last clip from Steve. This is at 38 minutes, 23 seconds. Already got it there. Okay.
That I certainly will be taken away from me. It's that Steve's given you the key to profitable trading here, but it's up to you to decide what indicators you're going to use, and certainly making sure that your returns are much greater than your losses. Because I've been there, making the buy and hold and hope versus the buy and hold and have a good strategy for exiting with profits or exiting with tiny losses. One post that Steve has put on Twitter several times, and man, it hit me right in the chin when I was holding gold. He said, your trade should either be a giant win, a small win, or a tiny loss. There should never be a giant loss. And I think a lot more people need to understand that it's okay to have a win rate much less than 50% if your returns are much greater.
Look at that. 6 years from then, I'm still saying the same thing. Big win, small win, break even, or tiny loss. There should never be a big loss. Funny. It's like the principles are universal.
Yeah, the major key to profitable trading is big wins. The major cause of unprofitable trading is big losses, and that's what you have to manage.
Yeah, and I think the management is really about your ego versus the stock price when that happens.
Yeah, the tools of every trade entry, really, once you enter a trade, it comes with the management. Where's your stop loss to keep it small? Where's your profit target or your trailing stop to make it big? And each day making a decision to maximize those gains, minimize those losses. Really, it's the trade management that really, you are your edge when you're able to manage your trades properly.
I love that right there. You are your edge when you are able to manage your trades profitably. All right, so enough videos. Let's finish out the slides here real quick. Now, I remember specifically, like we still have quite a lot to go through, by the way, but we're going to learn this together. I remember specifically looking at a chart like this with Steve. And so now we're going to go straight to the charts and we're going to look at them together. I remember looking at a chart like SMCI. And I remember Steve saying to me, actually, let's go to a different one that's not all marked up. How about Coke? Yeah, let me remove all my drawings here. I remember Steve asking me the question when he and I were working together. He's like, all right, Chris, do you think this is a good buy or a good or not? And I'm like, I don't know. He goes, well, which way is it trending? And this is a perfect example. And I was like, I have no idea. How do I know which direction it's trending? I'm going to teach you that. I'm going to teach you that exactly right now. So first, adding in the 50 period EMA. EMA is exponential moving average. Don't worry about what it means. All it means is it is a faster moving average than a simple moving average. The 50 period EMA. Now, this applies to the daily chart. However, it also applies to the 5-minute chart. It applies to the 1-hour chart. It applies to the 1-month chart. It doesn't matter. 50 periods EMA. But on a daily chart, that's pretty much 10 weeks, and I consider that the longer term trend. So let's add the 50 period EMA. All right, so looking at this right now, we can see where price was over the 50 period was when it was trending higher. Where price was below the 50 period is where it was trending lower. And even if you only use this one line right here, you can see some fantastic entries like this and huge exits like this. And look at all the profit you could have caught in between there, right? Now, there are times where you might make a buck or lose a buck, right? Let's say you get in right here and you get out right here. You might have made a buck. Got in right there, got out right here. You might have lost a buck, whatever. Same thing right here. But we don't know until it rockets with us if it's going to work out. We have no idea. We have no idea. So the 50 period is where we start from. And we can say, okay, well, look at this right now. Coca-Cola right now is above its longer term moving average, the 50 period moving average. So I can see, you know what? It's trending up right now. Facts. Cool. Thanks, Steve. That's something I had never looked at before. And then it's, hey, you know what? Take the 20 period EMA and add that on the chart as well. Now, this is your 2-week time frame if you're looking at a daily chart. So your 50 periods, your 20 periods is the same as 10 weeks and 2 weeks. And this would be the intermediate term trend, the intermediate term trend. So let's add the 20 period EMA. Okay, cool. Check it out. So we can see right here that we have the intermediate term plus the longer term moving in our direction. Okay, cool. That makes it a lot easier to see when that trend is actually working and working well, right? We can see it moving up like that. And we can see over here when it crosses over and goes the opposite direction. That crossover makes it a lot more easy to see. And then lastly, we have our longer term. We have our intermediate term. What about our short term? So that's when we add the 10 period EMA. Hang on, I'll type it right there. That's when we add our 10 period EMA. No. I had the typo on this page, didn't I? Hang on. Hang tight. Gotta make this right. You guys are getting these slides, so I don't want to mess them up. There we go. All right, so the 10 period EMA is equivalent to 2 weeks. So the 50 period is 10 weeks. The 20 period is 4 weeks. The 10 period is 2 weeks. These give you the exact same data points here. But this is the shorter term trend. So now we add that third moving average onto our chart. And we can see here, when all three are lined up together, that is your outlier trend template. Your 10 being over the 20 and price being over the 50. That is a bullish trend. Now, I've mentioned this before, and I'm going to continue to say it. There are times when you might make a buck or lose a buck. Like right here is choppy. And sometimes we can't help choppy. But we still have to take the opportunities when they're presented to us, because they could be choppy here and then huge right here. And really, what's the difference, right? If the 10's over the 20, price is over the 50 right here and right here, the difference is, do we trust the system and let it work? Or do we say, Chris doesn't know what he's talking about. I lost a buck here, but I could have made 50 bucks right here, and I chose not to, right? So here is where the trends lie, and this is where you want to be. You want to be riding the trends up and riding the trends down. And if we think about the sandwich example, right? Imagine this is the bottom of the sandwich. This is the top of the sandwich. And right in betwixt these 2 points is all the meat. Where's my drawing tool? Right here. In betwixt these 2 points is all the meat. Give me all that meat. Yum, yum, yum. Eat it up. Eat it up all the way down if you want to. Yum, yum, yum. Eat it up all the way up. Okay? We don't have to fight for the top. We don't have to fight for the bottom, but we have to be there when the moves happen. If we're not there when the moves happen, then we don't get paid. Okay? And you're only going to get paid when these moves are happening. Moving averages. Mathematically, stocks must go through this to go up. So this is why I can tell you this with no hesitation, with no reservation, and no worry that I could be wrong, because it is math. In order for the price to go up, it must go through the 10, the 20, the 50. It cannot go through the 10, 20, and 50 and go up. In order for a market to crash, it must go down through the 10, the 20, and the 50. It cannot go through, or it cannot crash unless it's on the other side of this. Okay? So to recap, it must be above them in order to go up, and it must be below them in order to go down. Now, there are times where it goes sideways a little bit, right? I can agree with that. But it cannot crash unless it goes through here first. Which means if you are in a trade and you are not watching these moving averages, you're not reading the market. You're not letting the market tell you which direction it's going. If you are reading it and you are seeing what it's doing, it's going up, you can go along with it. And now, it sounds crazy, but the 1987 crash, the COVID crash, the 2008 crash, every crash you've ever seen or heard of started going through the 10 and the 20 and the 50 before the giant moves happened. People were starting to get out. They saw the writing on the wall. They were paying attention to the market. And when it dropped and everybody else was left holding the bag, the smart money had already seen something wasn't right. And they took their exit signals and they got out of the way. So I want to stress that point. It cannot crash without going through these points first. Now, it can still gap through that point, right? But you can't be down way down here without having seen, oh, something's not right up here. Something's not right up here. And then time frames. Because these are principles, they're mathematical. They work on all time frames. You can apply the same thing to everything because it's just math. And you need to decide what your plan will be with that, right? Maybe you're a day trader, maybe you're a swing trader, whatever the case is. You need to decide where you're going to put these and make them work. And then lastly, here's your cheat sheet. Go ahead and take a screenshot. But this is an idea of what all these moving averages mean, right? The 10-day EMA is my number one primary indicator, and that's the short-term trend. This says the 50-period SMA. It could be the 50-period EMA, whatever. That would be a key support level in a long-term uptrend. Right? Different moving averages have different meaning to different people. So take a screenshot of this, keep that, print it out, put it on your board. Make sure that you put all of us lovely gentlemen in your screenshot whenever you take that and print it out on your board. Okay, that is a requirement. So that is all of my slides for today. I know today was a big day. I wanted to go through a lot because honestly, this is where we start getting really juicy. This is where we start learning, right? This is where we start finding applicable things that we can put together. So I want to leave a couple minutes for questions from these gentlemen here, and then a few minutes of questions for everybody else in the chat. So gentlemen online, how can I help you out? What questions do you have about today's lesson? Mikey Mike.
Okay, I'm going back to what we were talking about on the, when you said you don't use the 5% move anymore because it could be a huge move and still buy on the up. So when you change on the outlier screener, you have 0 to 5, and I forget the next one's 10, 20. Those. So what are you changing to remove that? To I don't know how to share my screen.
Oh, I got it. On the screener.
Okay, good, awesome.
Yeah, no problem. So on here, instead of saying 5 days, 0 to 5%, you can just go no selection and leave that blank.
Okay.
And that'll achieve the result you're looking for.
Okay, awesome. Thank you.
Yeah, easy peasy. Joe.
You mentioned you're willing to go back one day on your screener. Did you come to that conclusion based on back testing, or do you still need to do the back testing?
So a couple of reasons. First, Mark, so one of our co-founders, Mark, the algorithms behind Outlier, his idea, he was pushing me hard. He's like, Chris, you need to look at yesterday's signals as well. Because sometimes in the screener, it may be 1 day later when the heat map starts moving up, or 1 day later when all the moving averages cross over and it shows up here. And it won't show in day T, but it might show day T+1. And so he's like, listen, if you don't take those just after 1 day, you could be missing out on a lot. So that's actually where I got it from, was Mark was really pushing me on that. And then I forget, somebody mentioned it in the Discord one day. They were like, hey, this stock showed up today, but it wasn't there yesterday. And the reason being was, maybe the heat map was flat yesterday and today it's moving up. And it turned out to be a spectacular setup that I would have missed had I not had T and T-1, or T+1, I should say. Does that make sense?
It does, yeah, yeah. It sounds like there may be opportunities to go back a third day, but we don't know for sure yet if there is. The reason I bring it up is I think I found Foot Locker was semi recently tripped, but it stayed flat for a little bit, and then it just kind of went to the moon. So it had a buy signal, but we wouldn't have taken it if we were not looking back a couple of days.
Yeah, that makes sense, right? And those kind of things are going to happen. You can also get overwhelmed, right? If you go back too many days, you're going to be looking at 300 different buy signals, which is going to take a lot of time to go through.
Yeah.
So great question, though.
Thanks.
Anybody else? No? Very cool. All right. I'll start taking questions from the chat. If I can get you guys to start putting some questions in the chat, that would be awesome. And I will do my very best to answer them. Let's see. So Susan said, or Warwick was talking to Susan, we're all learning the rules as we go, and it's great to have a place where we can all ask questions and support each other. Absolutely. Well said. How do you get back to 1 day's screener? So this is my screener criteria right here. Actually, let me load my screener. Outlier bullish, apply. And so this would be today's signals right here. And it's organized by date originally. You can sort it different ways, but you can scroll down. There's May 20, May 19, May 16. That would be Friday. So there you go. That's how you would do that part, I think is what you're asking. Nico says, do you think the 10, 20, 50 are more established because they are round numbers as opposed to 8, 21, 55 Fibonacci numbers? That is a really good question. So I don't use Fibonacci at all. I don't know anybody who does. I mean, I've heard of people using it, but it's not something that's ever picked up on my radar. It's really for the fact of being anti-fragile, like we talked about earlier, right? If it only works on the 8 and only on the 21 and only on the 55, then it doesn't really work at all. But if it works on the 10 and the 8 and the 12, if it works on the 20 and the 21 and the 19, if it works on the 50 and the 55 and the 45, that is an anti-fragile way to look at it. But if it only works on 8, 21, and 55, that is an extremely fragile way to look at it. In my opinion, that would be overfitting the data. Let's see. Alexandra says, when screening stocks, what thresholds for signal return and capital efficiency do you make a rule out for a stock? Okay, great question. So we have signal returns on here. So these are the outlier signal returns, plus also the capital efficiency. And capital efficiency, the best way that I can describe it is if a stock has a capital efficiency of 1.0, that means you have the same returns per day as the market. But if it has 2.0, that means you're making twice as much per day as that stock does buy and hold, which is super common. In fact, capital efficiency right here, 9.92%, meaning for every day that you would be in the stock, you're earning nearly 10 times more than just buy and hold. Sounds absolutely astronomical. Let's go look at GSK real quick as an example. And we'll pull up the performance summary here so we can see what that looks like. Right. So GSK has negative buy and hold. Outlier has 69%, meaning we're making 10 times more per day than it would if you were holding buy and hold, which certainly it should make a lot more than that. And that's what the representation looks like right there. So we would be in the market 48% of the time versus 100% of the time, which would be 592 days versus 1,352 days. That's what capital efficiency represents, is how much more do we make per day that we're invested versus buy and hold. Michael Badinsky says, do you ever trade ETFs? I do, but I'll be very honest with you. I've just not looked at them. They're super simple to see over here in the screener. There's an ETF tab right here. You can pop that over. I even have a screener for my ETFs, and you can see right now, literally nothing. Not a single thing came through on my screener for bullish ETFs. So yeah, nothing's coming through on the screener, which means I'm not going to be trading it. Huey says, do you take into consideration stocks that go below the 10 EMA, often historically, but goes back up to your stop loss? If it's below the 10 EMA, that's already one of my exit points. If it's already at one of my exit points, I certainly would not use it for an entry point, because how could I have a stock that's below one of my exit points and enter that? Right? That's a conflict right there, because it's already past my exit point. I cannot put it on. So that would be the way that I'd look at it. Hopecast says, how can price go down but greed go up on a stock? So the fear and greed measures not just the price. It measures how many participants are in there. It looks at the news. It looks at all kinds of stuff that factors into the fear and greed score. I don't know exactly all the components of the fear and greed score, but it's not necessarily just based on price. Graham asks, is there a good online options chain page to check open interest and liquidity? The answer is your broker. You go into like Tradier. Hang on, I'll share my screen. You can go to Tradier, and it's going to show you your open interest. It's going to show you your extrinsic. It's going to show you everything right there. That honestly, that's the place to go to find it. S. It would be great if there was an option to limit the screener to only show signals past 1 to 3 days. I mean, it's already done for you. You just scroll back, right? Just don't scroll as far, right? So there's today -1, there's today -2, right? I mean, we're making it easy, but we're not going to like spoon feed it to you, I guess, if you want to think of it that way. Let's see. Jonathan says, why do institutions use the 150 day? I don't know. I mean, to them, that makes sense, I guess, right? There's probably institutions that use the 50. There's probably institutions that use the 200. There could be institutions that use the 372. I don't know. They have come up with their own rules, just like you've come up with your own rules, and they're trading based on that. Let's see. Sean asks, wouldn't the heat map rules always force us out of a trade way early if it ended up being a stock that steadily rose for months on end without crossing the 10 EMA? For sure.
Question.
That's 100% true, right? And I'm okay with that, right? In fact, I got an email from somebody, like they really took the time when it was my AT&T trade. They really took the time. They researched my email, sent me an email. It's like, Chris, I think we're missing the boat. If we get out today, then we're missing the boat on AT&T. And I was like, just follow my plan. Right? That's my plan. And that's what I tell you guys all the time. Come up with your own plan, figure out what works for you, and execute that. So for you, Sean, that may be the right thing to do, is using the 10 EMA as the exit point. And that's okay. Right? I'm not going to tell you this is the only way to make money. Just like Mark was saying in the video, right? There's probably lots of ways to make money. It's just what I do best. Let's see. Hold tight. Scrolling through lots of stuff. Yes, Paul.
I think to put a point on what Steve was asking about having the fear and greed kick you out of a trade, can a stock run for months and not cross over the fear and greed border? Is it because of what's making it cross over? Is it the volatility that we're currently experiencing? Can we stay at a 50 and the stock keep climbing and stay over the 10 EMA?
I mean, theoretically, it is possible, right? But more than likely, as more people are helping push the price up higher and higher, that would, in theory, push the greed up higher and higher as well, right? It would just have to correlate between the two. I don't know what the correlation would be, but that there's no way that the price could go higher without the greed also going higher. Right? But there's a chance it won't go up at the same speed. Like we talked about earlier, I think Joe had the question. It might go from 50 to 55 to 56. And then if greed really takes off, it might go from 56 to 77 overnight, right? And so that's the kind of stuff that can happen. And that's why I say, figure out a plan that works for you and execute on that plan. So that's going to wrap it for today. I feel like this was our best lesson so far. I hope you guys do too. I have the I may not have the slides put out in the university chat in our Discord, but I will in just a moment. But I do have the quiz, and part of the quiz, I'm telling you right now, you need to go watch the videos in order to answer the quiz questions. So if you want to catch those videos here, just do so on your own time. go over to the Outlier University playlist on my channel. It's the easiest way to find it, because I have 2,000 videos on YouTube, and I want to make it slightly easier for you. And watch these two over the next few days, because absolutely your quiz grade will depend on this. So make sure you watch those. So thank you guys so much for coming to Outlier University. I really appreciate having you all here. Thank you all for watching, and I'll see you right back here on Thursday. Be sure to click one of those two videos. One video is over my face and one video is over Paul's face, but that's okay. You can still click them. Y'all have a fantastic day. We'll talk soon.